So, good evening, everyone. Once again, my name is Yogesh, and welcome to this webinar powered by Century Financial. I see a couple of messages here, not able to connect, something wrong. Please, why not just send me a okay or a yes if you can hear me, so I can proceed with the session, because I'm sure there should be always a network congestion, because a lot of people are using doing webinars these days. So the software congestion is possible. But please send me. Okay, great. So I think most of the people can hear me. Those who have a trouble in connecting, or due to network congestion, or due to anything, or you might be busy with something, might have to get back to what you're doing. Do not worry about this. There will be a recording of this uploaded on YouTube very soon. So definitely, I mean, having a session live is one of the best things. You can ask your questions, and any questions you have, it will always, be a very good point of having a discussion while we are talking about it. But then, more or less, you can always book a one-on-one session with me, and I'll be more than happy to do the same session with all of you individually, if that is what is needed, because it's knowledge at the end of the day. We try to make investors aware as much as we can, and that was the whole point of initiating this entire series of webinars, where we have not only discussed about oil prices, we have talked about earnings, we have talked about trading strategies, we have talked about psychology of trading, we have talked about effective ways of investments, and it has been a whole wonderful series we have discussed in 2020. We have done Investor Education Week. I see so many names right now who have attended my sessions before. Welcome, all of you. And in fact, most welcome the people who have joined for the first time today. My name is Yogesh once again, and today we'll be discussing about the importance of trading strategies. And as I said, don't worry, even if you have any doubts or questions, please do write on the chat option. I cannot invite everyone to speak, otherwise there will be a further congestion in the network. So I'm taking questions on the chat. If you have any questions, keep writing. By the end of this session, hopefully I'll be in a much easier position to answer your questions. And we would have covered a lot of content over here. So at least for the next 1 hour, we can discuss. So to begin with, I'll be I'll be showing you actually a lot of strategies which we can do at times like this. And when I say times like this, please have your notepad ready, have your pen ready, because some points you might feel that are difficult to remember, so you can just write it down. Or if you have any questions you want to ask right now, just write it down, and you can reach me out later and you can ask these questions definitely. So please have a notepad and a pen ready. I'll make this session worthwhile for you. So today we are going to discuss a lot of strategies, and we are going to understand a few key important points in them. It might look very appealing to you, or it might be not your cup of tea. Maybe your style of investing is different from what I'm going to discuss today. But in either case, please understand this: investments in financial markets or in commodities markets, anywhere, investments, they have a risk, and that's your market risk. So there's a possibility that you might make a good money. There's a possibility that you might lose also. So you have to be very careful. Please do not borrow money from a bank. Do not take a loan from a bank to invest in all these things. Don't leave your jobs thinking that this is a source of income. It's going to bring a Ferrari in your house, or you can buy a villa after this. This is not one of those sessions. I can see there are a lot of people who have attended my sessions before, so they already know. I talk about facts. I talk about numbers, and there is no secret technical indicator I have. I don't have any pen drives to sell at exorbitant prices, which promise you any kind of profits. This is not one of those sessions. I'm here to talk real fact that markets are risky. You can make a loss, you can make a profit. Definitely, you have to ask yourself this question: that what's your risk appetite? Should I be doing this or not? Talk to your consultant about this. that how effective this strategy is for me. That's why financial consultants exist. So please understand this. Whatever I'm going to discuss, there is always a risk element in it. So unless you really understand these strategies, only go for it. Otherwise, talk to your consultant. Yeah. Now, starting with the strategy part, importance of trading strategies. It is why it is important. Tell me, just doing this poll right here. Everybody is here, and I would love if you guys participate in this. What do you like to do? You like to speculate or trade, or you like to invest for long term? I've not given both options. That's why I put what you like to do. I mean, you could have invested and speculated in both, but then what do you really like to do? Go ahead, guys. Give me a vote on this so I can understand what kind of crowd we are looking at. Speculate, trade, invest for long term. I think both are different things, because when you're trading, speculating, you're looking at throughout the day price movement or throughout 4 hours of price movement. But when you're investing for the longer term, you're looking at weekly, probably monthly trends and how they are working out. So, okay, that's great. Very informed crowd. Once again, that's good. Actually, both great. This is also something which is really needed. Now, I'm going to publish these polls. 87% suggest invest for long term, 12% speculation. Now, this is where we try to understand why people invest for long term. People invest for long term because there could be various reasons. You want to buy, you don't have enough time to get engaged on day basis. You would just like to buy and hold it for a longer period of time. Those who trade and speculate, they have understood the point that longer term may be too risky. Markets are too volatile, so you can cash in on the short term opportunities. Nobody is wrong. It's just the trading style is different. So that's why you need to have a strategy. Because when investment styles are different, you need to have a strategy for this. And you have to understand that trading strategy is very simple. Whether I'm going to go trade throughout the day 4 times or 5 times, which kind of asset classes I would like to invest into. Will I trade in gold? Will I trade in oil? Will I trade in silver? Will I trade in a US stock index? Or I would just buy shares and hold on to it. So day trading strategies could be different. Long-term trading strategies could be different. But what I'm here to discuss is the market neutral investing. Now, market neutral strategies are the ones which have got really good importance in 2020 because of increased market volatility. And you see this chart right here. It tells you where you put the market neutral investing when it comes to risk. If you are a passive investor, who is a passive investor? Passive investor is someone who would buy shares and hold on to it for a longer period of time, would not make any changes to it. Whatever the market generates, he is happy. So that is called passive investing. You're not involving any fund manager. You just bought and left it. That is passive equities. So if you see, even if you're a passive investor, you are on the right corner of the market risk. You still face the market risk. If you're an active investor, then you are slightly facing a higher market risk as compared to a passive investor, because you are rebalancing your portfolio every now and then. So you're an active investor. You're looking for different kinds of strategies, trying more. So you are more closer to the market risk. Then equity hedge. Equity hedge means you bought, say, a portfolio of shares, and then you bought a put option also, which kind of hedges down the risk. If the stock price goes down, then you have a hedge. You have a threshold which can protect you from falling markets. But they also face a certain amount of risk. Comes the last, what we are here to discuss today is equity market neutral. That means market neutral strategies which have low market risk, which have, when you see security specific risk is very high, but the market risk is very less. Why security specific risk on the left corner, if you see it over here, why on the left corner security specific risk is high? Because market neutral strategies are done specifically between two relative instruments. So if something happens to those specific two instruments, then yes, you are facing that risk. But when it comes to the market risk, that way, this particular strategy can be much protective as compared to other strategies. Now, what kind of strategies are these? Starts with a pair trading or a statistical arbitrage. Now, again, guys, keep your pen and paper ready. As I said, I will share with you how the pair trading works. First, understand how statistical arbitrage works. It's a very old tool, but statistical arbitrage basically involves model-based short-term trading using quant and tech analysis to detect profit opportunities. Now, when I'll give you an example, it will give you a much better understanding. The very first form of statistical arbitrage is pair trading. Now, what does pair trading does? Tell me, when I ask you the question, when I say the word Pepsi, which other company comes into your mind real quick, which is very much like Pepsi? Same industry, same regulations. What's the name you basically hear in your mind when I say Pepsi? Which is the other company which you feel is just like Pepsi, right? Coca-Cola, right? Most of you said Coca-Cola. Okay, that's perfect. Great. Now, when I say the word MasterCard, what is the name which comes into your mind? When I say the word MasterCard? Absolutely. When I say Pepsi, you say Coke. When I say MasterCard, you say Visa. Right? These are the names which you. Why these two are different companies? Pepsi is a different company. Coke is a different company. MasterCard is a different company. Visa is a different company. But why they come into your mind? Because they're very much connected. They have the same target market. They have the same product. They have the same regulations, same challenges. That's why they're related. Now, what happens is pair trading is done between such two instruments. Also, this is about stocks. When we talk about commodities, now in commodities, let me tell you, there are two kinds of oil which you can invest into. One is called Brent oil, and another is called West Texas oil. Now, Brent oil is the UK oil which comes from the North Sea. West Texas oil is the US oil which is produced by Shell. But both the oils are tradable. Okay, both are crude oils, both are tradable, but there is a slight price difference. Now, when we talk about pair trades, we are talking about such two relative products. What we do is we track their movement. We track the price difference between both. Now, for this, I will open my live trading platform, okay, which will give you more idea about how do we do this. Please keep writing your questions. This will help me to understand that how much you're understanding this. And I'm definitely going to show you now how do we apply these strategies in day-on-day basis. Okay, so now I'm opening crude oil. Okay, I'm taking you to my live platform, and this will give you an idea. So now you can see, and this is a live platform, guys. So these are the live prices which you see as of now. So I've opened only two oils over here. One is crude oil Brent. This is $55.7. And then there is crude oil West Texas, which is $52.80. Both are oils, both are tradables. How a pair trading strategy would work? Now, if you see the difference between both the oils, it is almost around $3, right? Now, remember this, take a picture of this, write it down in your notepad if you want. Crude oil Brent is 55.75, crude oil West Texas is 52.77, right? I'll give you 5-10 seconds to write it down before I show you the strategy which I have here. One is March contract, another is Feb contract. The WTI West Texas is the Feb contract right here, and the Brent is the March contract. So the March contract is 55.76 and West Texas is 52.78. Right? Now, let me show you how the strategy works. And after the session is over, you get a demo account, talk to your relationship manager, and they will give you a demo account. And you can actually do this strategy in your demo accounts and see the results yourself later on. So now I'm going to show you the strategy which is there. Share. Like this. I hope everybody can see this. Okay. Now this is strategy called, so we essentially are looking at pair trade. This is something which is called Brent WTI spread trade. So spread trade is also a kind of pair trade where we look at two instruments. There's a question, shouldn't we consider same expiry for both commodities? See, we'll never get the same expiry for both the commodities. The only point is, yes, what we should do is we should look at the new contracts, because sometimes what happens, today if I take a trade and tomorrow this contract is going to expire and it's worthless. So I'm just giving an example right now. Yes, normally when you enter into the oil trades, you should definitely look into the fresh contracts. Any contract which is closer like 2 or 3 days to the expiry, there is no point of trading into it. Plus, with us, you also get the cash commodity of oil, which is not a future contract. So you can take a spread trade in that also. So that is also something which is available on request. You can get a cash commodity as well. Now, right now, when we look at the Brent WTI spread trade, let's see what is. Now, when I say spread means the difference between both the prices of Brent and West Texas. WTI means West Texas US oil. Now, strategy behind Brent spread trade is to take advantage of the fact that spread in the prices is expected to increase when it is low and vice versa. So let's just look at this chart. This is not the chart of the oil prices. This is the chart where we have seen the chart of the price difference between Brent and WTI oil. There are two kinds of oil, the price difference between them. Now, we have tracked the price difference since 2015. At least you can track it as much as you want, but then the relevant data which we got was from 2015, where you can see there is a slight, I'll just zoom this so the numbers are visible to everyone. If you see 2015, there was a low of minus 0.48. That means WTI was actually 48 cents more expensive than Brent. Okay, that was in 2015. But after that, from 2017 beginning till 2021 currently as it goes, we have seen most of the time when the difference between Brent and WTI oil prices, when it is around $2 difference, it increases from there and goes up. Currently, it is around 3.06. So the prices what we saw right now is around $3 difference. Now the idea is, when we historically look at this scenario, we have seen many a times it has bounced back and has gone back to 6. Look, every time when it bounced back from 2, it went around $6. You see all these green spots over here, $6, $6. Now again it is around 3. So the idea is, the target which one would expect, that you enter into the spread trade at 3 and you exit at 6. Historically, that's what it has shown. Now, if you just read a bit of the text over here, crude oil spreads are currently around $3, which means obviously the Brent oil is at a premium. Guys, for anyone who has never seen these things, I'll just tell you in a very simple layman language. There are 2 coins of oil which are being traded. Both have a price difference, and we are trying to speculate or trade on this price difference. The Brent oil or the UK oil is at $3 premium as compared to the US oil, which means Brent is more expensive than WTI. Now, lowest in the last 5 years, we have seen minus 0.48, which means WTI at one point of time showed 48 cents premium as compared to Brent. While the highest in the last 5 years, and that's the most important thing, the highest has been around 10.99 on a weekly closing basis. So you see in the chart, $2 zone, crucial support. The spread has bounced from this zone multiple times in the last few years, and highest on a daily closing basis was $63 in the month of April when oil prices, US oil prices turned negative. Now, obviously, in the wake of pandemic, anyone who made money in pandemic or anyone who understood pandemic was a very abnormal year. So I cannot expect it again to go to 60 and tell you that 60 is your target. But what we see in last few years is that 10 to 12 is the highest which it has touched, and it has come down. A question is that how to plot the spread difference chart. This can be done in trade room. See, you cannot see the spread chart, but see, this is where the consultant with you actually comes of prime importance. You want to have a spread chart, it is easier on Bloomberg. You can easily see the spread chart on Bloomberg, and it hardly takes seconds. So if you call your consultant and tell him, okay, what's the current spread like, he can easily take out the chart and show you and even plot down the support and resistances for you. You can come to our office, spend time, use Bloomberg, and do it yourself if you want to. Both the options are available to you. Now, currently, as I said, the Brent March contract is priced at this, while WTI this, implied a spread of 3. How to execute this strategy? First of all, this is a spread trade. Now, spread trade means the spread is the price difference. How to execute this trade? Let me also ask another question so that may help me to understand this. Right here. Okay. Tell me, guys. So, because to understand the strategy, you should know about short selling, and it will be very easy for me to understand how many of you know about short selling, how many of you not. So I'll explain it in a similar way. Since it's a trading strategy session, so I'll just tell you how the strategy is done. But for a one-on-one session, I'll definitely explain you how the short selling is done as well. Please vote so I can find out what how much you can actually understand from this session. So that will be easier. Okay, that's good. 75% I still see they know about short selling. Okay, more people coming in. Okay, people are still voting. Okay, guys, 5 more seconds before I end this poll. So I'll get a slight idea. Okay, great. So I'll just end this. So I see 55% are not aware about short selling, 44% do know about short selling. Very quickly, I'll explain you how short selling works so you understand that why we are doing what we are doing. Question: there are very few opportunities that has been there when the spread has touched 3. So that's correct. So that's why arbitrage opportunities is not something which you get every day. And 3 is actually not 3 is not the point of support or resistance. 3 is the current spread, what is going on. What are we speculating on at this point of time is that 2 is a major support. Okay, so if it is at 3, then you can still enter into the trade because your target is 6. That's the speculation which we are looking at. So what happens is if it comes down to 2, there's a probability it will bounce back again. So if it is at 3, you can enter maybe smaller quantity. If you were to enter with 2,000 barrels, you go with 500 or 1,000 barrels, for example. If it comes down to 2, you again increase the quantity as per your risk and then wait till it goes back to 6. But being at 3 is a decent entry point, and that's why the flyer is there. Now, coming to the short selling is a very easy task to do. Short selling means when the prices are coming down, you can borrow that commodity from the broker and sell it in the market. And when the price comes down, you buy it at a cheaper price, keep the price difference with you, and the commodity goes back to the broker. So that's how the short selling happens, which means this platform provides you an opportunity to short sell, and the price comes down, you can make money out of it. Why I'm telling you about short selling? Because arbitrage or this kind of spread trade requires one instrument you should short sell, which means borrow it from the broker and sell it in the market. So if it comes down, you make profit. Another, you buy. So if it goes up, then you make profit. The idea is this price gap between oil, which is 3 right now, is expected to go to 6, right? Or it is speculated that it is expected to go to 6, from 3 to 6. Now, if that is the case, Brent is at a premium and West Texas is not at a premium. And the gap is between 3. So what do? You buy a Brent oil and you short sell WTI. So what happens is if oil prices fall down and the spreads go up, which means this 3 becomes 6, that will happen that if WTI falls down more while Brent continues or Brent falls down less, there is a difference of $6 now. So if you had invested 1,000 barrels, you have a $3,000 profit. Similarly, if the oil prices go up and the spread goes to 6, the scenario would look like your Brent has gone higher. So your profit in the buying Brent trade is more than the loss which you have on the short selling trade on the WTI, because oil prices normally move in the similar direction. So if the oil market is going up in a spread trade, what benefit you have that you don't care about the oil prices going in either direction. Oil prices can go in either direction. What you care about is the spread trade. Maybe oil prices went up. So maybe if you're invested in this spread trade, even if the oil prices went up, maybe Brent up by this much, so you made a profit, but then WTI is also up by this much, so you made a loss. So you are still at a break even. Your particular portfolio is hedged. You are not you're not impacted by the oil price up or down. Why? Because you're trading on this gap. This is what the speculation is. Your loss will be that this gap, which is 3, becomes 2 or becomes 1 or becomes 0.45 negative, which we have seen in 2015. That is what you call as the maximum drawdown, the maximum loss which you can face. So every strategy has a certain amount of maximum drawdown which you can face. We look at the historic data and we see, okay, this spread has gone minus 0.45 also. But then this is the game of probabilities. When we are looking at a strategy, we plot down that what is a good support level for the spread and what is the profit taking level for the spread. Quantities, as I said in the very beginning, that this is something which is under your risk appetite. You have to understand your risk into that, how much quantities you want to buy, because you have to do equal quantities. Now, let me give you the example. How will I execute this trade on a platform? So in this case, normally when you see both the kinds of oil right now, 52.91, 55.87. So if I have to do a trade, equal barrels, let's say 1,000 barrels, this is Brent, and this is WTI. So I'm short selling this 1,000 barrels. Equal quantity. So I buy one Brent and I short sell WTI. I go to my account, check my positions. I have both the oils right here. I have bought Brent and I have short sell WTI. So what I'm expecting the spreads to go higher, which means I'm expecting either Brent will go up or WTI will go down, but this $3 will become $6 gap. So you will see one position in a net profit as compared to, even if you have a loss in another, the profit in the other position will create a net profit if the spreads go in your favor. And if the spreads become more narrow, then that's where your loss is. So that is something, again, the drawdown that's when you are being suggested or recommended that this is something which you can do, right? Going back to the flyer, if you see, okay. Now, if you see here, the Brent March is currently priced at 15. Okay, this is done. Now, see, understand the scenarios, guys. Scenario when spread increases further. So I will take only first scenario, which is 6, because there are two scenarios in a $9 also, and then there is a scenario where it goes down also. So we are taking both the scenarios. Then what happens when the price gap increases? How it will look like? It says long Brent, short WTI. Long means, for people who are new, long means that you are buying Brent. Short WTI means that you are short selling US oil, just what we did in the platform right now. Number of units, this is taken with 10,000 barrels, but you can take accordingly, like I did with 1,000 barrel, you can do it 2,500, it's up to you. Current price of the spread 51.5, 48.5. So this is a difference of 3 when this flyer was prepared. Invested amount, total $1 million when you do the calculation. Now, if the price increases to 6, that means Brent, which you have bought, has gone up, let's say, by $6. And this 48.5 has gone up by $3. So total now the price of oil is 51 and 57. So this gap of 3 increased to the gap of 6. So in that case, what happens? You lose money in the short selling trade because you short sell WTI and WTI also went up, but WTI went up by $3, while the Brent goes up by $6. So your profit in Brent is higher than the loss in your WTI. That's where the net profit comes in. Okay, there's a question. Shouldn't the position sizing be on the amount invested in each commodities rather than number of units? So fair question. Somebody asked me a question that shouldn't we put it equal amount than the equal quantity? So statistically, what happens is when you are doing a trade on the basis of spread, on the basis of price difference between two commodities, the ideal way to do is in equal quantities, not in the equal value. If you are doing a ratio trade, now ratio trade is different. So I'll tell you ratio trade, how the ratio trade works. And it's just like a pair trade. So today, when we talk about market neutral investing, we are normally talking about these kind of trades itself. So when you're looking at a ratio trade, and a ratio trade looks like something like this. Let's say gold, products, commodities. So gold right now it's 1838, while silver 25.19. Now, guys, I want you to divide 1838 by 25 and tell me what the answer is. Divide 1838 by 25. What actually means 1838 divided by 25. Tell me what is the number which you get. Okay, that's great. Okay. 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 Perfect. 73, 73, 73. Exactly. Correct. All of you have answered. Thank you so much. Now, this is where you're looking at the ratio. This is the ratio of gold is to silver. Okay. Which means with 1 ounce of gold, you can buy 73 ounce of silver. Now, this is in a ratio trade, you definitely do it by value, not by quantity. How do you do a ratio trade and why I told you gold and silver? I'm going to share a chart of gold and silver with you, and just be with me. Check this out. See, right now I'm showing you from the here itself. See, this is the gold silver ratio chart. The ratio which is coming 73.52 right now when you divide the prices. Look, most of the time, there was a time it was around 70. Whenever it reaches around 80, it used to be a resistance. Here, so this is 75, again 76, again 75, 77, then again 80. There used to be a resistance. Unless what happened? Pandemic happened. When pandemic happened, this ratio went all the way to 113 and then very quickly came down also again to 68 and now it is 73. So there are a lot of opportunities you can exploit in the gold silver ratio trade also by buying. So if you're expecting that the ratio will fall down, what do you normally do? If you're expecting ratio will fall down, what you will do? You will buy silver equal value and you will short sell gold. But if you are expecting ratio to go higher from 75 to 80 or 85, you will buy gold and short sell silver. So just to give you an example, let's say it is 73 and you are expecting that the ratio will go higher to 75. So what you do is say $25,000 buy gold and $25,000 short sell silver. So you buy gold here, you short sell silver over here, and the trade is done. So here is another pair for you, which you can see. This is gold and this silver, equal value, 25,000, 25,000. So when there is a ratio trade, you use equal value. When there is a spread trade, like oil spread trade, you see equal barrels. Right? So we did a gold silver ratio strategy also. But till the time it worked really well, but when pandemic happened, it actually backfired for a lot of investors because they were expecting ratio to fall down, but nobody accounted the pandemic. And we saw in the pandemic, the ratios actually going from 85, 86 to 130. So that's why, guys, I say that there is always a risk in strategies also. But sometimes what happens is strategies like pandemics are not really always, it is never in your portfolio that a pandemic will happen. But otherwise, under normal market volatility, these kind of strategies can be really helpful to understand. Now, in WTI and Brent example, will it be good if we keep the same month contract? See, more than same month contract, check the current contract. And current contract may or may not be the same month. I mean, if right now it is 19th of January, so you look at what is the current contract for Brent and what is the current contract of WTI. Mostly, if there is a 20-25 days remaining to the expiry, go for that contract. Because that's, I think, fair enough to keep at least that much. You normally see spread moving around those lines. Right? Now, moving on to, so we understood about pair trades, and pair trades are of many forms. So we'll try to understand, let's say, yeah. Now, pair trades can be in equities also, and I will show you in equities as well. But first, let me show you another kind of strategy, which is called seasonality analysis. Now, seasonality analysis is different from the pair trade. Seasonality analysis, what we do in seasonality analysis, we try to develop a heat map. And seasonality analysis can be done in commodities mostly, like natural gas, platinum. It can be done in gold also. It can be done in agro-based commodities like soybean, orange juice, wheat, sugar, coffee. Normally, seasonality analysis is all about back testing the performance of that particular commodity over last 8-10 years and trying to find out which month it has given maximum positive or negative returns, right? So it is again a game of probabilities. What happens is, now we have taken, I'm going to show you one strategy over here, and this is again a seasonality based strategy. Okay, right here. Okay, now look at this. This is, guys, a seasonality analysis strategy, and you will understand how seasonality analysis works. And these are very recent strategies, so I mean, it's a good time to even discuss with them that if anytime you feel like taking few trades in it, you can talk to your consultants and do it. Now, this is and it's more like a quarterly strategy. So it's not very long term. It's mostly on quarter basis, and you can understand them. Somebody asked me a question: what would be a good pair trade for Dow Jones? I think at this point of time, see that Dow and Nasdaq has the highest ratio trade history. So anytime Nasdaq, US 30 and Nasdaq has been very very good pair for us back in 2018, 2019. But now let me compare the ratio, and then I'll definitely get back to you. It's a very good question. With Dow, normally Nasdaq goes really well because there are a lot of stocks in Nasdaq which are in Dow also. Okay, now look at the platinum seasonality analysis. Below is the seasonality comparison of platinum over last 29 years across each quarter. As can be seen, the first quarter performance has been positive 22 times, whilst only 7 times the first quarter has seen negative returns. Now, if you see, this is more of a quarter-on-quarter trade. Okay, so we are not looking at month-on-month in this one. We are looking at quarter-on-quarter. Every year, the first quarter has exceptionally performed well for platinum, with a 29-year average return of 5.5%. Over the same period, maximum return has been 33% for one quarter, and maximum loss has been 25%. Moreover, after every negative performing year, platinum has given a rebound with positive return. So if you see here, let me show you this particular map. Okay, so this is a heat map for platinum, and look at from 1992. Every first quarter has been checked. Okay, so if you see, most of the time Q1 for platinum has been more positive as compared to Q2 or Q3 or Q4, and this is in last 29 years. And if you see, the maximum return is in 2008, 33%, maximum loss in 2020, which is 25%, right, in the Q1 which happened. Approximately 40% of platinum demand arises from automotive sector, 20% from industrial uses. Now, this is where the fundamental comes in. Jewelry accounts for 30% of the global platinum demand. China, largest market for platinum jewelry, followed by India, and US platinum is a preferred choice for engagement rings. With both the global wedding season and New Year festivities in the first quarter of each year, demand tends to rise during this time. Likewise, strong Chinese demand emerges in January ahead of the Chinese New Year and the Lunar Festival. Mass rollout of vaccination, unprecedented stimulus by governments, anticipated V-shaped economic recovery across the world will result in more industrial output, higher car sales, and elevated consumer spending. Thus, there is a high probability of outperformance for platinum. So, as I said, when I was starting the session, that I will only talk about facts and logic. What we are looking at as of now, so we just showed you that, okay, there is a possibility. We have did analysis on platinum. Q1, majority of the times is positive. Last year, in Q1, it was negative. This year, with the vaccine coming in, production again getting back, industrial output is expected to go better. So most likely for the first quarter, prices might show you a bounce. So that is something which, again, at 29 years of backtesting data says, and that's what the heat map says. So this is what seasonality analysis is. In terms of agro commodities like soybean or coffee, we would go back for 10 years and maybe see month on month that which is the best month for soybean or which is the worst month of soybean, and we can accordingly tell you that you can short sell or buy. So this is something which is again based on research, statistics, and then we also look at the fundamentals. Like soybean, you will see most of the time prices are negative in August. Why it is? There could be reasons. Maybe the new seed is just sown in August, harvesting is still far off, so the old crop is very much flooded in the market, so the prices come down. But as soon as the harvesting happens and the new crop is about to come, the farmers, they do it. So basically, seasonality is something which you can study and do a backtesting, create a heat map, and see that which has been the most positive, most negative months of all this. And many a times seasonality has worked, given what is the probability. Like in this case, Q1, the probability is higher for platinum to go technically, and fundamentals also support at this point of time. So Q1 is a much better. Highest return you can make 33%. lowest you can make 25%. So there is a drawdown which is also calculated throughout these 29 years. Right? So that is, again, as I said, this is a different strategy than pair. Okay, how to create a heat map? Is it automated? Heat map, again, if you sit on Bloomberg, spend some time, you'll be able to create it. It does require Excel skills also, not that difficult. So the idea is, again, the consultant is there, he or she will be able to do it for you. So if you like to do it, please talk to the consultant, come to my office, sit on a Bloomberg, and we will even tell you how to do it. So that is again something, it's not a very big rocket science or something. This is very easy to do it. And research, it's just research. And that is something which is more important. Right? So going back to the strategies which we were talking about. Now, I'll show you one more strategy. In fact, there are few more strategies. Something again on the likes of, it is still a pair trade. But this time, this particular trade is more likely to be between two indices, because somebody asked me what's the best pair with Dow Jones, right? So I'll show you something which we call as interest earning ideas. Okay, and this strategy we have been doing this with South African index and Nasdaq. Now, South Africa and Nasdaq, these are two indices. Guys, keep your pen and paper. I'm not sure whether you are noting this down or not. You can click a picture, of course, or you talk to our consultants. They can explain to you how this is done. But now, the Nasdaq and South African index is something which you will not even think about. Why I'm pairing Nasdaq with South Africa? Nasdaq is US, South Africa is South Africa. Why we compare both of this? This was a result of, again, a research which we did. And this is something which we coined as interest earning ideas. This is where we put the holding cost feature into it. Right here. Okay. I hope everybody can see this. Okay, guys. Now, see, you can see this is an updated version of the flyer released on 18th April 2019. This one was done on 31st December 2020, because this has been going on for a while, and if it gives good results, we continue with this anyways. And so what happens is, now this is what we also call this as NASA strategy, which is Nasdaq and South Africa. The strategy involves short selling South African index and buying Nasdaq. On the other hand, it involves, again, so you buy the tech index, which is Nasdaq. If you buy Nasdaq, you have to pay a holding cost of 0.1% yearly. But if you short sell South Africa, you will receive a cost 5.6%. Easier to understand, if you short sell South Africa index 1 unit, by the end of 1 year, you get around 5.6% if you hold on to it for 1 year. If you buy Nasdaq, by the end of 1 year, you pay 0.1%. So net, you still make it on interest which you receive on short selling the South African index. Again, guys, I'm sure there are a lot of people, interest feature may not be, maybe due to religious concern, if it doesn't suit your investment style, then no worries, you can always look into other investments. For those people who would like to understand this, see, right now you're looking at the performance, and I just want to show you the first 4 or 5 columns, how they have shown. The year from 2008 to 2020. So this is I think it's in the almost year till date 2020, because 2021 has just started. Now, if you see Nasdaq yearly return, and then you see South Africa yearly return, and then if you had bought Nasdaq and short sell South Africa, then what would have been your net return? And then you add a net received holding cost onto it, because South Africa index, if you short sell, you always receive more interest than you pay in Nasdaq. And then you see your final total return, which is in column 5th. Leverage is up to you, how much you want to leverage, because there is 2 times leverage, 5 times leverage, but then it depends on your risk appetite. So even if you go with 0 leverage. Now see, yearly return in Nasdaq in 2020 was 47%. South Africa yearly return was 7%. So South Africa went up by 7%, Nasdaq went up by 47%. If you were long on Nasdaq, you made 47%. But you were short sell on South Africa, and South Africa went up by 7%. So you lost 7% on South Africa. But net, you made 40% because you were long on Nasdaq. Also, the net holding cost which you receive is around 3%. Because you short sell South Africa, you earn interest. You buy Nasdaq, you pay. So net interest also is around 3.4. So you receive around 43.4% as your net return for 2020. 2019, this was different. Now 2008 to 2020, there have been two occasions where first was 2012, where this strategy gave negative return of 8%. And after the holding cost, the negative return was minus 3%. 2008, when recession happened, this strategy gave a negative return of 16%, but after the interest coming in, the total negative return was minus 7. Why I'm talking about negative returns over here? 2008 markets crashed. Had you invested into individual indices or economies, you would have faced a bigger loss than just 7%. But if you had done this strategy where you were long on Nasdaq and short sell on South Africa, see how you got yourself protected, because Nasdaq went down by 42%. So you lost 42% in Nasdaq. But South Africa went down by 26%. So you made profit of 26% in South Africa. Look at 2008 stats. So that was 16% negative return which happened. But after the net receiving holding cost in South Africa, your total return negative was minus 7. In 2008, where people lost so much of money in equities, you lost only 7%. So that's why the strategies are built in to protect you from the market volatility also. Okay. Question: why South Africa will be an advantage for holding cost? It's cost, so it's an expense to the investor. No, so that's right. Why we call it a holding cost? For the reason that it appears on the platform as holding cost. So we are just trying to make you familiar with the terminology. Holding cost in itself means, see, when I'll give you a very basic idea. When you short sell something, you borrow it from the broker and sell it in the market. Hypothetically, if you have a notebook, you understand it, and when you're borrowing and selling something in the market, hypothetically, your account should be credited with a plus amount, right? So when you borrow something and sell in the market, you receive this amount. Now, normally this amount which you receive and brokers keep with it, there is a certain amount of interest which you receive over it. Now, that interest depends upon which currency you have taken and which economy you are dealing with. So normally in case of South Africa, the interest rates would have been higher in case of US, because US interest rates have been mostly down and negative. Mostly on the lower side of it, not negative. So that is the reason why that most of the time, and these interest rates have changed, but most of the time you have always received net, because when you buy Nasdaq, you pay less than when you short sell South Africa, you receive more. So that is the reason that why this particular strategy, again, game of probabilities, right? In last 12 years, we have seen 2 times this strategy showing negative returns. That also outperformed the market. 2008 outperformed the recession. So that's why you need to understand, it's just not about making profit. It's about minimizing your losses also, reducing your risk as well, right? So this is something which is important. I think it is. Yes, very important question. Is there any currency risk here? So we also calculated the point, because if you're trading South African index, then you are trading in South African ZAR. You're buying Nasdaq, you're trading into dollars. So when we calculated the currency risk also, dollar has outperformed South African ZAR throughout this tenure. Throughout 2008 to 2020, we have seen dollar outperforming South African ZAR. So currency risk exists, but then if you see last statistics, it has completely outperformed the South African currency. There is a fundamental reason also behind what I am telling. So strategy rationale, fundamental idea behind the strategy is well-established top US tech stocks tend to outperform these South African companies over the longer run, and the hedged positions will try and minimize the losses in case of downward trending markets. As witnessed in the year 2008, naked long positions in Nasdaq 100 would have resulted in a loss of 42%. However, the pair trade resulted in a loss of 16%. Again, important note, it's not a risk-free strategy. The difficulty comes when prices of two securities move opposite to the positions taken, right? So there is always a risk. Going forward, why is South Africa fundamentally a good short? Short means why we are short selling South Africa over a coming time. Stagnant economic growth, worries over electricity supplies, volatile South African currency rand will continue to be a drag on the equity market, making it a good shot. Moreover, the volatile nature of commodities and political environment of South Africa continues to create threat for Johannesburg market. Why Nasdaq is a buy? Because witnessed gains almost 50% in 2020 as online shopping, streaming, social media, gaming found every reason to surge in this year as these activities conform to social distancing norm. So again, guys, as I said, we are looking at a lot of past performance also. We are looking at a lot of fundamentals also. And the idea behind strategy is not only to talk about profit, but even to talk about what happens when your investments are in a loss. So even to minimize the risk, also you need to have market neutral strategy in your portfolio. Okay, now come again. A question is, where would you put a stop loss for this strategy? Again, completely up to your discretion. So that's what I told you. At this point of time, when we talk about the negative part, so look at this entire throughout 12 years. See, the maximum negative it has gone is 16% in 2008. Sorry, total return. Maximum negative we have seen 7% or 3%. Even if you exclude holding cost, just look at actual return 16% negative, 8% negative. So I feel if your loss is going more than 16%, then you should close your trade, because then it will be a new low. So that's where you have to find for yourself that, okay, the biggest low we have seen was 16%. Like how in oil spread trade, the lowest spread you saw was minus 0.45. So if your loss exceeds more than that, then you should close your trade, because then it's historically a new low. So it doesn't mean it is going to bounce back from there, right? So that's where, and that is one way. Second, because there is an exposure, how much money you have invested and how much risk you are willing to take. Maybe you are not willing to wait till 16%. Maybe your maximum benchmark is, okay, if I lose 5%, I want to close this trade. So you have to manage your quantities accordingly. That's why it is important. Again, you need more details. You talk to the consultant and we will explain it to you definitely that where you can put a stop loss and how do you put the stop loss in. Right? Now, before we leave, there is one more strategy which I want, and this is more bond-based strategy, and this is a recent talk about. So we're talking about the bond yield spread. Now you understood the price spreads, right? The bond yield, first of all, what is a bond yield? Bond yield is the return an investor realizes on a bond on its maturity. So bond yield is the return to an investor from the bond's coupon and maturity cash flow. So if you buy a bond and let's say it expires at the end of 5 years, it gives you an interest year on year. So by the end of 5 years, when you sell that bond, the total money you made on the buy and sell and the total interest you earned over it completely makes the yield. Now, every government bond, the yields are tracked. The bond spread or the yield spread, what does it refers? The yield spread refers to the difference in the yield on two different bonds or two different classes of bonds. Let's talk about a German bond and an Italian bond. If the German bond yield is say 1 and the Italian bond yield is 2, so the difference between the yield spread is 1. 2 minus 1, 1. The price of the bond, now this is where you should know, yield is different, the price of the bond is different. The price of the bond moves inversely with its yield. So if price decreases, the bond yield increases, or the bond yield increases, the price goes down. Where the bond yield increasing is the sign of risk increasing with that particular issuer of the bond. So higher bond yields means higher risk. Today, if you buy bonds from Maldives or Sri Lanka or Greece, their yield is very high, but their risk is also very high. Right? Their price could be very low. They are available on a discount because they are riskier. So their yield becomes higher because most of the bonds are redeemed at par. So that's where you have to understand the yield spread has nothing to do with the prices. Yield spread means how much an investor is expected to realize by the end of the maturity of the bond. Now, what happens is, right now, the strategy which we are talking about today, that is depend on what is going on in Italy right now. And we are calling it as the BTP or the bond yield spread chart. This will be before we finish with last strategy, which will be a price action analysis. I'm going to share this very important strategy with you. Check this. Okay, here it is. Now, this is BTP. BTP is Italian bond. Bund is a German bond. Now, when you're looking at the yield spread chart, just under current Italian government led by Prime Minister Giuseppe Conte is on the verge of collapse. I'm sure everybody must have been reading about Italian politics as of now because it's in the news, not because it's an interesting thing. But it's on the verge of collapse after the former Prime Minister, the former Premier Matteo Renzi, quit the ruling coalition. Now, this has resulted in the investor confidence diminishing in the Italian government. Moreover, investors are increasingly concerned that the breakdown might hamper Italy's COVID-19 virus response and cause a delay in the efforts. Now, if you see current yield spread, the differences between the German yield and the bond yield is around 119. Okay, and highest it has gone is 326. And if you see now, since 2016, the lowest it has gone is 101. Now, the 10-year bond spread between the German and Italian bond has contracted to 5-year lows. Amidst the ongoing uncertainty over the government's future in Rome, the market seems overly optimistic. A blow-up in political tensions could result in a widening of yield spreads. Worst-case scenario of an election, there is a possibility of Eurosceptic parties. Which are Eurosceptic parties? Which are mostly anti-Euro. Parties gaining on others' expense. Nevertheless, even if the political tensions abate, Italian bonds seem richly valued related to its German counterpart. Scenario may provide an attractive opportunity to benefit from a long German bond position and a short position of Italian BTP. The crux of this is, which I want to tell you is, short sell the Italian bond. So expected to short sell the Italian bond because the yields mostly are expected to increase. Why you short sell the Italian bond? Because when the price of Italian bond goes down, their yields will start going higher because due to the political tensions, the bond becomes more riskier. When it becomes more riskier, so the price of the bond falls and the yield rises. And this is the yield spread we are talking about. So you short sell an Italian bond and buy German because as compared to its German counterpart, Italian bond prices might go down, yield goes up, and people might start investing more into German bonds as compared to the Italian counterpart because Germany is much more stable as compared to Italy. So the idea is German bond prices might go up and the yields fall, while the Italian bond prices might go down and the yield increases. So this gap of the yield spread might again start getting higher. So this is, guys, again, we are looking at bond strategy. Now, these were few strategies which I want to discuss, and we should not forget this is earnings season. So there is one more strategy which is left, and that is one of the best. It is called price action analysis. Now, those people who would like to trade stocks during the earnings, just understand this, that price action analysis is something, how we backtested so much of data we went into past years. Price action does kind of same thing, but now it does it with stocks. And how you understand the price action analysis? Let me open this for you. Okay, right here. So this is the last strategy of the day, and I'm sharing it with you right here. Okay, perfect. Now, price action analysis is when you look at a stock before its earning and compare the same quarter, but with different years. So right now you're looking at the price action analysis of Goldman Sachs and Bank of America. Now, when you look at Goldman Sachs and Bank of America, look at what kind of data we are looking at. This data shows Q4 performance of Goldman Sachs after the earnings come, and so if you buy the stock one day before the earning and you exit on the day of earnings at the closing, how the performance has been in last 10 years of the same quarter, If you buy the stock on the day of earnings and keep it for 1 month and then exit, then how the stock price has performed in last 10 years of the same quarter. Now, this is important because when you see Goldman Sachs, if you enter on one day before earnings, which was yesterday, and exit tonight, which is 19th, you will see an average return which is expected is plus 0.8%. However, the probability of gain in price is just 30% because most of the time, if you see, quarter four has always most of the time has been negative for Goldman Sachs. But why we are doing a price action analysis? Because we are comparing Q4 in last 10 years and checking that on an average, it has still given 0.8% return. Because as you see, 10% increase, 4% increase, 7% increase. So on an average, you still gain 0.8%. But the probability of gain in price is just 30%. This is if you buy one day before the earnings and exit on the day of earnings. The second column, where you see this, where you buy on the day of earnings, but you keep it for 1 month. The average return you generate, looking at the past Q4s in last 10 years, is 2.4%. Probability of gain in price, 60%. Here you can see how much max drawdown is expected in this and max gain. Look at Bank of America. Now, Bank of America, look at the last column. If you buy on the day of earnings and exit after 1 month, you expect a 2.5% return, but 80% gain in the 80% probability of gain in the price. Now, there could be several questions connected to it that it's just a probability. I understand that this is exactly a probability. But imagine when you are trading stock during earnings time, you actually don't know what it is going to be like. You don't know how the pandemic has impacted the earnings. So when you are looking into a stock, it really helps you to determine the same quarter over last 10 years that how stock has performed. Again, if you see, it has nothing to do with good or bad earnings. It has everything to do with how Q4 has been. If you buy a stock on the day of earnings and keep it for a month for Bank of America or for Goldman Sachs, how it is expected to turn out looking at the past historical data. So this is, guys, these are trading strategies. As I say, why I have put 1 day also and 1 month also is for the same reason that some of you would be wanting to just trade on day basis. So earnings is the best month to trade into stocks. Without a doubt, you can see a lot of volatility, a lot of movement. So you can use price, because this price action analysis, when just not doing for Goldman Sachs or Bank of America, there are a lot of companies. It has started today. So you will be seeing a lot of price action analysis. And as I said, please take a demo account. I mean, what you need to do right now is, first thing, if you have any questions, please go ahead and ask. We have anyways reached the end of the session. But more than that, please take a demo account and you do these strategies. Talk to your relationship managers, ask them. They are supposed to be telling you. They will help you out with these kind of strategies, and they will tell you that, okay, you can do it. This is something which, let's try it in the demo: oil spread strategy, platinum seasonality, price action analysis, BTP and Bund strategy, NASA strategy. See, so many strategies are there. And I have not even talked about a speculative trade, like you buy and keep a stop loss. Because naked and speculative trades are always there. There will always be swing trading strategy and day trading strategy and scalping, something which you can always find content on Google. This is something what a lot of hedge fund managers would be doing. This is something different from the daily speculation. So the point of the matter is there any risk? Absolutely it is. There is always a risk. In whatever you do, there is a risk. But then risk needs to be managed. You have to either manage your quantity, you have to manage your targets. You talk to your consultant, will try to understand which strategy fits best. Maybe NASA is not for you. Maybe price action is not for you. Maybe BTP and Bund based strategy is not for you. But maybe the spread trade is for you, right? Maybe the gold silver ratio is trade for you. So this is something, again, risk is everywhere. There is no trick, no technical indicator which can make money for you. So just be careful. Use these strategies. Ask me any questions if you have. and we'll definitely want to do a one-on-one session with all of you, free of cost. Talk to your RMs, and if you want to have more understanding, there is one question here: what time horizon one has to keep holding the positions? See, definitely. I mean, in pair trading, what is happening is because volumes are high, so if we get multiple entry and exits, then we normally tell the clients to exit. I mean, depends on a decent percentage of profit. So that is again, guys, something it depends a lot on your risk appetite. Because I've seen clients sometimes they hold on to the trade for a very longer period of time. Sometimes people have very low risk appetite because they have limited amount of funds. So it absolutely depends on how much risk you are willing to take. On the basis of that, we'll understand the horizon. Okay. So, okay, somebody asked how to open a trading. So opening a trading account is very easy. You just need a couple of documents. More than that, just talk to relationship managers first. Opening account takes just 2 days. But for now, take a demo account and do these strategies, learn this. Even if it doesn't work for you, at least try to buy and sell and understand how short selling works. So you will know that when you have to do a portfolio, you can use all these things, right? Once again, thank you very much to all of you. Please stay safe. The cases in UAE we have seen it has been increasing from a while. Please make sure that you're wearing your mask, you're using your sanitizers. On behalf of Century Financial, my entire team, myself, my family, a big word of thanks to anyone who is working in healthcare industry or a medical representative or has a friend or a colleague or a family member who is working as a doctor. I think it's a great sacrifice the medical and health representatives have done for us, and it is still happening, still going on. We have not won this war yet, but needless to say, these are the real heroes whom we have to appreciate. So all of you, once again, a big word of thanks, and we'll meet once again with a different session, with a different topic, and we'll keep doing these sessions now. We have started over here. Guys, also, by March, we are soon starting our seminars again, something which we have always been doing from so many years, but due to pandemic, we were not doing it. But now, keeping in mind, of course, how the condition is, we'll see in March how it works out, if the vaccinations work well, if we are able to provide you a complete health and safety parameters and properly, a proper event which can be conducted with safety standards. We'll definitely do a seminar also where you can personally come and ask your questions and even trade live on these platforms. So once again, guys, thank you so much. You have a great night. Please talk to your relationship managers, take demos, and use these strategies. My name is Yogesh. You have a great night ahead. You can, about future seminars, century.ae, or just talk to your RMs. They can absolutely inform you. You will have a relationship manager now going forward. So just talk to them, and definitely you get to know about more seminars and webinars when we do it.